All right. Hello, everyone, and welcome to our Impacts of Market Volatility on Employee Incentives presentation. We're excited to have you join us today. My name is Jim Gregory, and I'm a partner in the Executive Compensation and Employee Benefits Practice Group here at Lowenstein Sandler. I'm joined today by my colleagues, Darren Goodman, who's partner and vice chair of our practice group here in New York. Chris Oswald-Moores is also partner in our group. She's joining us remotely from an undisclosed location, I'm guessing in New Jersey. And Zach Bosian is here, and he's an associate in our group also. Before we begin, I would like to quickly go over a few housekeeping notes. For those of you seeking CLE affirmation credit, this program is eligible, and we will post a link to the CLE affirmation form in the chat. During the course of our discussion today, we will read aloud 2 CLE codes that you will need to record on your form. The first code will be read in the middle of the program, and the second code will be read at the end of the program. Additionally, we'll provide SHRM credit at the end of the presentation. You will also receive a thank you email from us afterwards, which will include a link to the CLE form and evaluation survey, along with a copy of the presentation materials from today's session. Lastly, if you have any questions during the discussion of the presentation today, please type them in the live chat during the presentation. We will save a few minutes at the end of our discussion to answer as many questions as time permits. So with that introduction, we'll begin the program. So interestingly, when we conceived of this topic in early April, as some of you may recall, the markets were sort of crashing, and there was a lot of uncertainty about, what was going to happen, in the coming months and maybe in the longer term also. Of course, it's barely 2 months later, and the markets have largely bounced back. But I think that illustrates the point about volatility. You just don't know when things are going to go up and when they're going to go down, and it has a pretty dramatic impact on employee incentives, which is really what this presentation is all about. When we were thinking about the topics again in April, when the markets were down, we of course were thinking in terms of, what are the sort of recurring compensation issues that come up when the markets are down. So for example, underwater stock options is a huge issue for many companies, obviously a huge incentive component for employees. And when the market goes down and the stock options have a strike price that's greater than the current value of the stock, that's not a very positive incentive for the employees. And many employers come to us, or their compensation consultants, or whoever they, have these discussions with, and start thinking about what can they do to deal with underwater stock options. Also, when the market is down, the capital markets sometimes freeze up. The M&A market freezes up. The IPO market freezes up. It becomes more difficult for a company to make an exit or have an IPO. And that delays and defers the incentive compensation exit event for the employees. So oftentimes where that's a factor, employers will come to us and say, what can we do to re-incentivize or keep these incentives alive for our employee base? And that's obviously that's more of a factor for the executive team probably than it is for the regular line employees. Also, when the market is challenged, we see company-wide layoffs. We see reductions in force because of declines in the business, the revenues of the company. Again, more difficult to raise financing, more difficult to raise capital. So with that overview in mind, if you can jump to the next slide, Zach. This is a basic overview of what we're going to be talking about today. We're going to be starting with option repricings. Darren and Zach are going to discuss the mechanics and the issues around that. And they're going to start with a more detailed discussion on the impacts of Section 409A, which you really have to understand some of the basic valuation rules in 409A to address these valuation type issues, because 409A really applies to most of what we do, including for private companies and public companies. Chris and I are going to then discuss extending post-termination exercise periods where stock options are maybe about to expire, or employees are terminated, and they typically would have to exercise within some short period of time and are unable to do so, and we'll talk about that. Chris is going to focus on non-cash compensation, long-term incentive plans, and MIPS, which have different flavors, so to speak. And then Darren and Zach are going to talk about something that we're seeing a lot of these days, which are double trigger RSUs, which have their own peculiar aspects and can be very tricky and complicated, but we're not going to go too deeply into the woods there, but I think you should understand what those are. And then if we have some time at the end, I'm going to just talk about valuation opportunities that come up when the markets are volatile like they are today. So with that being said, Darren, Zach, if you want to start with 409A.
Thanks, Jim. So as Jim mentioned, the markets have been volatile over the last 2 months or so, and the public markets do affect the private markets, which before we get into option repricings, we have to make sure we set sort of a foundation around Section 409A, which is a section of the Internal Revenue Code of 1986 that regulates non-qualified deferred compensation.
And for a stock option, the upshot of 409A is often that you need to set the exercise price of the stock option at no less than fair market value on the date of grant, which is more challenging for a private company than a public one where you have a market price.
Right. And how do you figure out what fair market value is, which is not entirely clear under 409A. But those valuations are only good for 12 months after.
Right. So the 409A standard is really vague. You have to determine fair market value by the reasonable application of a reasonable valuation method, which leaves a lot to interpretation. But there's a presumption in the rules where if you get an independent third-party valuation, you are presumed to have set the exercise price properly for up to 12 months. And these valuations, known as 409 valuations, people get them all the time. And if the valuation firms look at the public company markets as one of the metrics that they use to determine the value of private companies, so the decline in the public markets, if there is one, can flow through to those 409A valuations, resulting in companies getting new valuations that show lower value potentially than their prior valuations.
It's really, to just use a different term, it's a safe harbor, right?
Safe harbor,
Yeah,
that's
yeah,
right.
yeah.
Yeah.
And it's important to remember that if a material event occurs after you received one of these valuations, you might need to get another one.
That's exactly right. These valuations are good for up to 12 months, but if there's something material like a term sheet is received that establishes a different price, that can cause your valuation to become unreliable in a shorter period of time than 12 months. Next slide, Zach.
So one of the first solutions to addressing a volatile market that we thought we would discuss are option repricings. Both private and public companies can do them, but the rules are different for both. How do they work? And why do you do them? Option repricings are intended to restore incentive value to employees and retain employees in times where the price of equity might be volatile.
And just as a background, when we say repricings, what we mean is the exercise price is greater than the new fair market value. So you lower the exercise price to the new fair market value. So suppose someone has an option with an exercise price of $10. You get a new 409A valuation that shows the stock is only worth $5. The repricing would lower the exercise price from $10 to $5.
Which is a good thing for employees holding equity in the company.
Sure.
What steps are needed? So for public companies, these repricings do typically constitute tender offers, and they're are different regulations as opposed to private companies.
Yeah, you have to prepare a tender offer document. There's SEC tender offer rules you have to think about. So it can be a pretty time-consuming exercise.
And for private companies, these typically are not involving tender offer rules, just more internal consents by the board of directors or the compensation committee, depending on the types of options being repriced.
Yeah, so there's two types of stock options: incentive stock options and non-qualified stock options. The difference between those two is how they are taxed. The incentive stock options have the potential for more favorable tax treatment, with emphasis on the word potential, because in many cases, people don't actually benefit from that. But because of, as part of the trade-off of having a potential for more favorable treatment, the incentive stock options, known as ISOs, are more heavily regulated under the tax code. One of the requirements to get the tax benefits of an ISO is that you exercise the ISO and hold the shares that you receive until the later of 2 years from the date of grant and 1 year from the date of exercise. So it's the later of those two things. And if I do an option repricing, that's treated like a new grant. It restarts the clock on the date of grant. So if I had an option that was granted 5 years ago, as of today, I've satisfied that 2 years from date of grant requirement. But if I do the repricing, I go back to day one. So if I reprice my option today, it's like I'm being granted it today. I have to hold the shares for at least 2 years from today
To maintain ISO.
if you want to get the ISO tax benefits. And that's an adverse consequence. And the upshot there is that often equity plans require going to your ISO holders and getting their consent, because this is an adverse effect. And some plans allow companies to do this unilaterally, but even then it's typical to still disclose it to your incentive stock option holders and get their consent, just so that the ISO holders are aware of this consequence and are voluntarily agreeing to it.
So without getting too deeply into the weeds here, because people when we start talking taxes, their eyes might glaze over. What are the tax benefits for ISOs? I mean, at a high level.
Sure. So the tax event for a stock option normally is when the option is exercised. If you have an incentive stock option, any gain on time of exercise is not subject to ordinary income tax. The catch first is that the gain does count for purposes of the alternative minimum tax, which is a separate set of income tax rules that primarily impacts high income taxpayers. So someone could unexpectedly trigger that alternative minimum tax without realizing it, and until they do their taxes the next year, potentially. That is different from a non-qualified stock option, where when you exercise that, your gain will simply be taxable as ordinary income, just like salary or bonus is taxed.
Presumably there is gain between.
Assuming there is gain. I mean, if there is no gain in most circumstances, you wouldn't expect someone to exercise.
And this immediate taxable hit for a non-qualified stock option, which is ordinary income on the spread, the difference between the value at the time you exercise and the strike price, is a big factor when we talk about extending post-termination exercise periods, which we're going to be talking about when you guys are finished with this topic.
Absolutely.
Yep.
Next slide, Zach. So a separate aspect of the repricing with respect to ISOs. So there's a cap of $100,000 worth of ISOs that can become exercisable per employee per year. When you do the repricing, it's treated like a new grant of an ISO, and you have to recalculate that, and there's some quirky rules around it. For companies these days that are on CARTA, where by and large many ECVC companies are, CARTA will do those calculations. So from the legal perspective, we normally disclose this fact to option holders so that they are, again, on notice, because it can sometimes cause incentive stock options to convert to non-qualified options. I've never seen anyone turn down a repricing for that reason, so it's really a matter of disclosure, so there's no surprises.
And what that means is any of the ISOs that become exercisable in that year. should be calculable mostly to the $100,000 limit.
Yes, it gets pretty technical pretty quickly, but it's something, I think the big picture is if you have incentive stock option holders who have a significant amount of options, it's something to think about. For very technical incentive stock option reasons, the incentive stock option holders are given up to 29 days to consider whether they want a repricing. It can be less than 29 days, but we always like to give people enough opportunity to consider the offer and consult their own tax advisors if they have one. And then all of these nuances are incentive stock option related. So if you have a non-qualified option, you don't have to worry about the 100K limit or the timing limit. If all you are doing is lowering the exercise price, there's no adverse effect on the NSO holder. The board or committee can normally just lower that exercise price, and then you just let the employees know that it's happened. But we do sometimes see companies where they want to condition the repricing on a release of claims or a change in the vesting schedule. And if that's the case, then no matter whether you have incentive stock options or non-qualified options, you would need to go to the person and get their consent.
Because it's a modification, right? What would be considered a modification?
Well, it's something that is potentially adverse to the employee. And normally you would need to get employee consent to anything adverse. So a few other repricing considerations. I just want to highlight the first three here. The first one is former employees. There are nuances and potential 401(k) complications in including former employees in a stock option repricing. Many companies say, why would we include our former employees? There's no incentive value there. And I agree with that completely. But there are still some companies, whether they feel like they owe it to the employees or out of a sense of treating current and formers equally, want to include them. It's always something that has to be carefully looked at because there are potential issues. Overseas participants. Everything we're talking about is US specific. For companies that have option holders overseas, there are country specific rules regarding its repricings. So we have companies that they want to keep it as simple as possible in order to do the repricing as efficiently as they can. And they say, you got to still be here and you got to be in the US. And they eliminate the formers and the non-US. Other companies do want to include people overseas and they talk to local counsel and make sure everything is fine under local law. And then the last point I want to emphasize here is repeated repricings. So we mentioned that under 401(k), the exercise price needs to be at least fair market value on date of grant. If you have a practice of repeatedly repricing stock options to lower the exercise price, it could make it look like rather than you're setting the exercise price at fair market value on date of grant, you really have a floating exercise price because you keep lowering it, that and creating a 401(k) risk. So there are companies that have repriced more than once. It was fairly common a few years ago with the decline in 2022 for companies to reprice twice. It is something that companies should be aware of because they don't want to go into this expecting that if our stock continues to go down, we can just repeatedly reprice because they could potentially run into some 401(k) trouble there.
And since we're right on that topic again, generally, when you have a violation of a 401(k) violation, the option holder is immediately subject to an accelerated income tax as well as a 20% excise tax in addition to that accelerated ordinary income tax, plus interest, plus penalties, and then there are various local considerations.
Right. And the way those rules work is that after you pay those taxes and the penalty is if on your gains at the time, if the stock goes up in value, that increase again is subject to income tax and the penalties and interest. So it could just become an ongoing problem. And that's why we put such emphasis on avoiding 401(k) issues.
And from a company or employer perspective, that also leads to reporting corrections for the tax that would be owed.
Yeah, there's a box to check or there's a code to enter on the W-2 that's issued if there's a foreign A violation for the prior year. So the burden would be on the company to report that. And if it is not reporting, then it has potential exposure. And it also has to withhold on the income tax. And if it is obligated to do it but doesn't, the company can become liable for that tax.
And I think I've never seen an executive employment agreement or a compensation plan that doesn't have boilerplate 49A language that says in no event will the company be liable for messing it up. But if they do mess it up, there's going to be, some problems with those employees for sure.
Yeah, because it stems from a company,
yeah.
can stem from a company decision. And as a practical matter, companies may feel they need to make employees whole for these taxes to keep them happy.
Absolutely.
And in addition to the employee reaction, where I believe we see it come up sometimes, a lot of diligence on a deal where there could potentially be a foreign A issue like this.
Exactly. Foreign A issues are often raised in the course of M&A transactions where a buyer's doing diligence. So the cleaner you are foreign A wise, the easier it'll be in benefit plan diligence. Could probably skip this. I think we.
Okay. So we're gonna now talk for just a little bit about extending the post-termination exercise periods. Chris and I are gonna take this piece. Again, for those of you watching who have stock options or who've had them in the past, you probably know that it's pretty typical to have a 90-day or 3-month post-termination exercise period. If you're fired or if you quit, you've basically got that period to exercise your options, which is really not a long time in the grand scheme of things, especially where you might have an option that had a 10-year term. It's really sort of a quirk, so to speak, where you have non-qualified stock options. There's no requirement that you limit it to 90 days or 3 months. That's an ISO requirement, and which is sort of spilled into the NSO world, so to speak. So that's the standard. And you can flip to the next slide. It really does cause a hardship for many employees who are leaving because, especially when you have a non-qualified stock options, we talked about earlier, there are two things that have to happen in order for you to exercise that NSO within that 90-day period. One is you have to come up with the exercise price, which may or may not be a lot of money depending upon when you got the stock and what the value of the stock was when you got it. But you also have to pay the taxes on the spread between the current fair market value and that exercise price. And if the company has gone up in value significantly, which many have, of course, that's a real burden. And many employees don't have that liquidity to pay the tax and the exercise price. So to help them out, employers will sometimes, not always, but will agree to extend the post-termination exercise period. And they might do it to get a release of claims. If there's, for example, if there's no severance that's otherwise payable, that would be the consideration for release. They might extend PTIP to get the release. Or they may just do it as an accommodation or a kind of a goodwill gesture for an employee who maybe, spent many years at the company and is leaving for family or other reasons. So there are reasons that this happens, but there are particular rules that apply. You can go to the next page. And this, Chris is going to get more into the details on exactly how you go about extending PTIPs.
So this may sound like a theme after Darren and Zach explained ISOs to you earlier. There are more rules if you have incentive stock options and you want to extend PTIP. Typically, as Jim said, including for ISOs, the exercise period is normally 90 days. Extending it for ISOs is considered under the ISO rules a modification that could disqualify it as an ISO, and in that way potentially deprive the employee of the tax treatment that they could get if everything else lines up as well with an ISO. As discussed with repricings. Normally you would extend this offer for a 29-day or less consideration period to fit within the ISO rules for it not being a modification. And you normally need express written consent of the incentive stock option holders for this. Normally this can be done through a release agreement, which would satisfy the consent requirement. For non-quals, as discussed earlier, it's easier. They typically don't require written consent, and they don't have the same modification rules. And also generally with this, you cannot extend beyond the original expiration date. So I think a typical extension might be a year post termination, but theoretically it could be to the end of what the original term of the options was.
Chris, do you see employers sort of taking kind of a blanket approach on this issue, or are they kind of one-off, or does the executive bring it up when they're being terminated or leaving? I mean, what's the dynamic there?
I think a lot of times these would be one-offs, except if you're doing a reduction in force, it might be done to a broader group. But I see these being negotiated. Do you see something different, Jim?
I totally agree. I think that's exactly how it comes up. There was some discussion a number of years ago about the market moving towards, having these extended periods sort of baked in to the awards when they were made, but I don't think that really happened. So it's really something an employer can kind of offer at the time of the separation, or the executive can kind of try to demand or negotiate as part of a separation. Yeah.
I want to read the first CLE code because we're almost halfway through. So the first CLE code is 645377. That's 645377.
Think,
So
interest
you
of
could-
time, we should probably skip this, right, Jim? Move on.
Yeah, let's kind of move on. We have a lot still to cover. So Chris is going to talk about the impact of volatility and other forms of compensation, including long-term incentive plans and MIP arrangements. So go ahead, Chris, please.
Okay, so companies that are looking for alternative ways to incentivize employees, such as if they don't want to give equity for one reason or another, or are looking to incentivize certain kinds of performance, or are looking to conserve cash and or retain key employees. These kind of plans can do all kinds of things, and there's some flexibility here to design them around what the particular goals are. So broad categories, and there's some overlap in what these types of plans are, as Jim said, would be a long-term incentive plan, which is typically some sort of a bonus plan. I mean, really, these are all bonus plans at heart. Another kind would be what we would call a management carve-out plan, which also may be referred to as phantom equity or synthetic equity, and these are typically paid out on a change in control.
Why do they call it a management carve-out plan? What's the genesis of that, Chris?
The idea is to carve out part of the change in control proceeds for the management before the shareholders share in the change in control proceeds.
Right. So that kind of brings up an interesting point, which is to really understand how many of these plans work, you have to understand the capital structure of the company. And so many employees, when they're joining a company and they get a stock option or they get an LTIP award or a MIP or a management carve-out plan, they look at they don't really know what they're getting, honestly. And sometimes the employer HR people don't explain it to them, and that can lead to a lot of confusion and issues down the road, in my experience. But if you don't understand kind of what the common equity is and what the preferred is and what the debt is, and what you're going to get and where you are in line, you really don't know what you're getting.
Yeah, there can be a lot of complexity, or these can be designed to be sort of simpler depending on what the needs are and what you're trying to drive towards. In terms of the long-term incentive bonus plan kind of plans, some sample features you would be, you could design it to be, say, a 3-year rolling plan that's tied to company performance. So say you set a performance goal for year 1. If it's hit, you would have a pool or awards that could be paid to employees annually over 3 years if they're still employed on the date of payment in each of those following 3 years. Another way to do it, if retention is really the important goal, is to give cash grants that vest over 4 years or whatever period of time you're trying to drive towards, and require continued service on each date of vesting, and then you could have them pay immediately, and that keeps people wanting to stay employed for that company so they can get their payments. You can also tie the actual payout to company performance. You can give different awards to different participants. One way to do these would be a fixed cash award, such as a percentage of someone's base compensation, and then maybe you have a bigger percentage if you hit stretch targets. Another way to do it would be to have a pool and give people either units or points in that pool and have them get a proportion of the pool. These can get very fancy or they can be fairly simple. And the eligible participants could also change from year to year. So what I would normally talk to clients about when they're trying to design a plan, whether this kind or phantom equity, is who are the participants you want to include? What are the goals of the plan? What value do you want them to share in? And what payment timing do you want it to be? Zach, can you go to the next slide?
Sure.
So yeah, so you would, if you're designing this kind of plan and you're trying to drive performance, you need to identify upfront what are the performance goals and then tailor the plan to that. If you're going to do it as a pool for a long-term incentive plan, you could make the pool a percentage of the company's annual profits. You could do it as a fixed amount. You could even leave it just to board discretion. As I mentioned, you'll want to determine what are going to be the times of payment. And then to the complexity point, you need to figure out upfront, how is the company going to track this and fund it if it's a rolling plan that's paid out over years. With all of these kind of plans, you always have to worry about Section 409A. It kind of boxes in the terms. Sometimes companies will, to avoid some of the complexities of 409A, structure a plan so that continuing employment at time of payment is a requirement. And this gets a little complicated if, for example, you wanted to provide a benefit if someone's terminated without cause or dies or becomes disabled. So that's part of the conversation here and part of the consideration. With these plans, you also have to consider whether the payments are going to be considered excess parachute payments under the Section 280G rules. And also to mention, with these kinds of plans, this is ordinary income. So it's typically deductible by the company, but it's ordinary income to the recipient.
If I can just add one thing. So a lot of these plans, Chris, they, especially sale bonus type plans and some of the pool type arrangements, have hurdle concepts, right? Where, if the company sold, the pool size depends upon the value of the sale and whether they get above a certain number. For example, maybe there is no bonus pool if it doesn't sell for more than X or Y. So in this valuation volatile world that we're living in, you have the same idea or concept as you have with underwater stock options or repricing stock options. I mean, this obviously different rules. These are not ISO rules or even 409A rules in many cases, but it's the same economic concept, right? That you've got an incentive that no longer works for the team. And so you want to revisit that or rethink it, if that makes sense.
Yeah, so you have a plan where it pays out if the sale proceeds are over 100 million, but now your value is way under 100 million. You have no hope of recovering.
Exactly.
It loses the incentive value.
Exactly. That's exactly right.
So then you'd be revisiting your plan and either amending it or making a new plan.
Absolutely.
Yeah, exactly.
I think that's a great point. Zach, can you go to the next slide?
Sure.
So phantom equity, these are typically change in control bonus plans essentially, and can be designed different ways too. A lot of times we'll see a participation pool that could be either a percentage, a flat out percentage of the net proceeds, or a percentage of the net proceeds above a certain amount or above different scaling amounts, as we were just talking about. They can get pretty fancy or be pretty simple too. Typically, you will require employment through the change in control event or other service in order to get paid, but companies will consider carve-outs and design around that. Typically, there's a requirement that the employee deliver a release to the company in order to get this payment. And often there will be an expiration date that the change in control has to happen by that date in order for this plan to still be in effect. And again, as with the other of these types of long-term plans or change in control plans, we need to consider Section 409A, Section 280G, and the fact that these are also ordinary income payments to the employees.
So Chris, if there was an issue under 280G, what does that mean in practice?
On the change of control, if something counts as an excess parachute payment, the individual would have a penalty tax and the company can't deduct the amount. And there are ways of addressing that, especially if it's a private company, but it is something that has to be addressed one way or another.
And for a private company, they would often cleanse it with a shareholder vote. And there's a few nuances around it, but one that's important to know going in is that as part of the shareholder vote, you would prepare a disclosure document to all of your stockholders where you would disclose, we have this phantom equity plan, and here's what is being paid to the people who have a 280G issue. So your stockholders could see potentially, what the CEO's bonus is on a sale. So it's always something for people to be aware of, because that's no one's ever happy about that, but there's just no way around it under the 280G rules.
Yeah, that's a great point. Darren, thank you, Chris. So Darren and Zach are now going to discuss double trigger RSUs. Our practice group meets regularly, and one of the things we always talk about is what are we seeing in the market, because it's always changing and it's interesting and relevant for other clients. And we're seeing more of these arrangements now, and maybe you guys can describe them and talk about why you think that might be the case.
So just as background, a restricted stock unit is an equity award. When it's granted, the employee does not receive any shares. They just have a right to receive shares in the future. And when they receive those shares depends on the terms of the restricted stock unit. They're not taxed when they're granted the award. They're not taxed when they vest in general. They're taxed when they're issued the shares. So it's a way of delaying the tax bill until if and when the shares are issued. And another important aspect of restricted stock units is that they are full value awards. What that means is that there's no exercise price. You don't have to exercise these.
Like you would an option.
Right, like an option. And there's no purchase price normally either. So whatever a share is worth at the time that it's issued to you, that's your benefit with respect to the restricted stock unit. So it could never be underwater like a stock option where you need to reprice it to restore the incentive value. There will always be some value to the restricted stock units as long as the stock itself has some value.
And with these, there's two triggers, obviously. So when someone is granted these, they must meet both a time vesting component and a performance or liquidity component. Typically that liquidity component is an IPO or a change in control like an M&A transaction.
And the goal here is to delay the tax event until someone has the liquidity to pay the taxes. So hypothetically, you're a private company, you could grant a restricted stock unit that vests simply over time and you issue them the shares as they time vest. But now the employee has a tax bill and the stock is not liquid, and it's hard for the many employees to actually pay their tax bill.
Right.
So by requiring both a time vesting element, because you don't want people to vest on day one, as well as the requirement of a sale or change or IPO, the idea is, if we issue the shares and we sell, you'll sell your stock to the buyer. if we issue you the shares in connection with an IPO, you'll have liquidity because the stock is now publicly traded. It can get a little more nuanced because, for example, there could be a lockup in connection with the IPO, but that's the basic idea.
It sort of solves the problem that we have on the options when you have vested options and you leave and you have to exercise within a certain period and pay the taxes on the spread if they're non-qualified stock options, but there's no liquidity event and it's a private company and if you don't have the money in the bank, you can't do it. So this is another vehicle, an instrument that kind of gets at this, like making sure that at the time of the tax event you have the liquidity.
And
Right.
there are
Yeah.
ways to address that liquidity problem
Right.
in lockup, like a net settlement. or
Right,
cash.
issuing fewer shares and covering taxes on
Right.
people's behalf. And I think, Jim, you hit on one of the scenarios where it's most helpful to issue these double trigger RSUs, where the company's stock has a value that's so high that if you gave them options, they couldn't afford to exercise anyway.
Exactly.
Another scenario where these are useful is when a company's growth days may have largely been in the past. So if you give an option, there's less potential appreciation, and therefore it's less of an incentive. The biggest downside often is that for these double trigger RSUs to work under Section 400A and to avoid a 400A violation triggering those consequences that Zach talked about earlier, there has to be a deadline for the sale or the IPO to occur. The IRS rules don't say what the exact right deadline is. Under the IRS rules, the deadline simply has to be short enough that it creates a substantial risk that the sale or IPO does not occur by the deadline. And if the sale or IPO does not occur by the deadline, the double trigger RSUs would simply be forfeited. The market practice is that a 7-year deadline is a deadline that works under Form A, but it's very fact and circumstance specific. Hypothetically, if you have a company that's closely held, there's no intent to ever sell. I mean, that could support a deadline that's longer than 7 years. If you're in the middle of negotiating a term sheet, on the other hand, to sell the company, a 7-year deadline could be too aggressive. So it's case by case.
And Jim, maybe in the market we can talk about too. In other practitioners talk about a longer period. And we've talked about that sometimes, and it's not always perceived well.
Yeah, the accounting firms usually have a point of view, and again, like Darren was saying, 7 years seems to be the default these days.
But I've seen companies go up
Yeah.
to 10.
Yeah. Yeah. But it's interesting what you were saying about one of the reasons these full value awards are so attractive as opposed to an option with a strike price is when the company has that high valuation. The original these double vested RSUs were really developed in the Valley in connection with Facebook before Facebook went public way back when, and people thought, oh, there's no more upside on that stock. Ultimately they were wrong about that, but it kind of took off in the market, and we didn't hear about it for a while, but now we're hearing about it more. But as a full value award, like Darren was saying, it has value as long as the stock doesn't go to zero. You have value, so you don't have to worry about resetting or repricing, RSUs. So they're attractive in that way.
Absolutely.
Go ahead.
So an issue is for some companies is that when they grant the award, they expect to sell or IPO before the deadline, but there is always the risk that they don't. And what happens if you are approaching that deadline? It's a problem for companies because their workforce is potentially losing their incentive equity without any compensation. So there's a few potential things that can be done. The overlay for all of this is that it's going to be company specific, and you always have to be thinking about, am I doing something that is okay under 401A or potentially problematic there? A few potential possibilities are, waive the liquidity event vesting trigger. So in other words, if someone has time vested and they're simply waiting for a sale or IPO to occur, you waive that sale or IPO requirement and you just issue them the shares. Now that results in the person having taxable income. So companies would need to plan around that. That dovetails with one of the other approaches on here, which is outside investment. You could settle the shares and you could simultaneously have an arrangement with an investor who wants to acquire shares where they're willing to buy the shares from the people who receive their double vesting RSU shares. You could let the RSUs expire and then after the fact do a new replacement equity award. I wouldn't see that expressly tied to the expiring RSU. It would just simply be something that's new going forward, and the company could revisit, do we want to do RSUs again? Do we want to do something else? It would be a discussion at that time. The company could also grant the new equity award before the double vesting RSUs expire. That way the executive team knows that they will have something even if they lose the RSUs. There's potentially some overhang there where you have a period of 2 different awards outstanding at the same time. So it really becomes a company specific and a fact and circumstance specific discussion as to what approach companies want to take in this situation.
So we're going to finish with just some kind of more general discussion about valuation opportunities. The compensation arrangements that we're primarily talking about are driven by equity values, as you know, as part of this discussion, because we're talking about volatility of markets, and the currency of these compensation arrangements is the equity, and the value of the equity drives those programs and those plans. And as we've discussed already, there are multiple ways of establishing a valuation for a private company, and this is really where we're primarily focused on the valuation model piece, because for a public company it's easy. The public stock price is the value of that stock. For private companies, we have to figure out what that valuation is, and it's really more of an art than a science, you might say. Many of you watching are probably familiar with 409A valuations, which we talked about earlier, which get done typically at least annually by private companies. Our venture capital VC-backed companies do them, at least that often, and sometimes more if there's been a change in circumstances or a material transaction, et cetera. But even if you look at those 409A valuations, they don't use one method. They'll sometimes use 2 or 3 methods, and then they'll take an average. Again, because it's not an objective determination. But what you do see in those valuations, and Darren alluded to this earlier, is often they'll look to the public markets and see what's happening, with comparable publicly traded companies. And we know the prices of those are very volatile and fluctuate. And if the market is down, that would be a down or discounting factor in the 409A valuation. Also, if the cash flows for the company are volatile and irregular, they would be discounted further. Similarly, if the earnings are volatile, they would be discounted. So all of these factors come into play and really allow the company to take a position that the stock price or the value of the company has declined. And once they do that and the board signs off, there's an opportunity to reset underwater stock options, for example, or to establish that they're underwater. And then you could do the resetting that we've talked about, or issue new tranches at the lower strike price, which is a great incentive for employees who are, very disincentivized by having the underwater options. And then finally, and interestingly, Black-Scholes is a very technical option pricing model that gets used in the market. It's standard practice for public companies. Many private companies use it as well. We're not going to get into the intricacies Black-Scholes pricing models because it's quite complicated. But one of the factors is if there's a higher volatility assigned to the stock, the option has a greater value. So even though people are upset and concerned, holders are concerned about the volatility or the volatility of the stock and the decline in price, the option actually, if you have a new option with a 10-year term, has more value in a volatile market because there are going to be more opportunities to get the favorable price movement. So that's just again an observation that I don't think a lot of people consider, but I think it's material in the longer term. So I think we're actually out of time on the actual formal part of the presentation. Do we have any questions or?
No questions in the chat, but I will ask the room. Before I do that, I just want to read the last CLE code for everyone. 974633, 974633. And with that, if anyone has any questions, please feel free to use the chat, or I'm not sure if you can unmute and speak as well, but happy to address any questions.
All right. If there are none, thank you very much, everyone. Thank you, Chris.
Thank you, Chris.
And we look forward to seeing everyone the next time we do this. Thank you so much.
Bye, everyone.
Good afternoon. Thank you.